Has your investment portfolio gone so deep into the red, it looks embarrassed by its own performance? That sinking feeling. It's familiar, right? The news is screaming about a crash, the charts are plummeting, and your hand instinctively reaches for that sell everything button. Stop. Take a deep breath. Today, we're going to talk about how an ancient philosophy, born over 2 millennia ago, can become your best financial advisor in 2024. We'll explore how the principles of Stoics, like the Emperor Marcus Aurelius and the philosopher Seneca, can help you not just weather a market downturn, but actually come out stronger. Think philosophy and finance don't mix. I promise, by the time you finish this video, you'll look at your portfolio through completely different eyes. First off, let's quickly define what Stoicism actually is. Forget the image of a stone-faced person suppressing all emotion. That's a Hollywood myth. In reality, Stoicism is a practical philosophy, a kind of operating system for the mind. Its main goal is to help you achieve a state of inner tranquility and clarity, regardless of external circumstances. The key Stoic concept we'll be using today is called the dichotomy of control. It's simple, like all genius ideas. The world is divided into things we can control and things we cannot control. And what exactly can an investor absolutely not control? The daily market swings, global news headlines, or the decisions made by central banks. But what can they control? Their reaction to those events, their strategy, and their own actions. This simple distinction holds the key to both financial and emotional balance. Let's start with the big question. Who or what is the investor's greatest enemy? Most people would immediately say a market crash, inflation, or bad news. But the Stoics would simply laugh at that answer. They knew the primary enemy wasn't sitting on Wall Street. It was right here, inside our heads. It's our own emotions, fear when everything drops, and greed when everything soars. These two horsemen of the apocalypse force us into the dumbest actions, selling at the very bottom and buying at the absolute peak. The market is merely a tool, it is neutral. Our reaction to its movements is what truly determines whether we win or lose. Imagine a surgeon who panics at the sight of blood. Would you trust them? So why do we entrust the management of our money to our own panicked selves? Stoicism teaches us to be that surgeon for our portfolio, cool-headed, calculated and focused on the process, rather than the emotional noise swirling around us. This is the first and most crucial step toward financial stability. Before you can manage your money, you must learn to manage yourself. Let's put the Stoic principle of the dichotomy of control into practice right now. Grab a piece of paper or open up your notes app. Divide it into 2 columns. In the left column, list everything related to your investments that is completely outside of your control. For example, today's stock price, tomorrow's breaking news, inflation rates, global politics, and the opinions of financial analysts. This list will likely be long and, frankly, terrifying. Now, in the right column, write down everything you genuinely can control. For instance, your investment strategy, the size of your regular contributions, portfolio diversification, the decision not to sell during a panic, and the time you spend researching companies. You'll notice this list is much shorter, but it is infinitely more important. Stoics teach us to dedicate 100% of our energy and attention to the right column and completely ignore the left. Stop refreshing the ticker every 5 minutes. Instead, check if your portfolio is aligned with your original strategy. This simple exercise shifts your focus from helpless anxiety to constructive action. You stop being a victim of the market and start becoming the architect of your own financial future. Let's dive deeper into the first principle derived from the dichotomy of control. Focus on your actions, not the results. Imagine the Stoic archer. They do everything perfectly, selecting the finest bow, drawing the string with just the right tension, factoring in the wind direction. They have complete control over the execution of the shot. But the moment that arrow is released, it is beyond their power. A sudden gust of wind might knock it off target. A Stoic archer won't tear their hair out if they miss. They judge the quality of the shot itself, not whether it hits the bullseye. The same logic applies perfectly to investing. Your shot is your strategy. You can select high-quality assets, diversify your holdings, and contribute regularly to your account. You are doing everything right, but the market might turn down, and your portfolio could temporarily show a loss. That is the equivalent of the sudden gust of wind. The inexperienced investor judges themselves by the red numbers in their app and begins to panic. The Stoic investor, however, will tell themselves, "I followed my plan. My actions were sound. The outcome was not up to me." This approach relieves immense psychological pressure and allows you to act rationally, rather than flailing about or making erratic decisions. Let's move now to one of the Stoics' most powerful, though perhaps a little grim, exercises. It's called premeditatio malorum, which roughly translates to the premeditation of evils. It sounds ominous, but in practice, it's an incredibly valuable tool for any investor. The concept is simple. Instead of simply hoping for the best, visualize the worst-case scenario in detail. Sit down in silence and ask yourself, what is the absolute worst thing that could happen to my investments? Let's say your portfolio drops 50%, not 10, not 20, but half its value. What would you do? How would this impact your life? Will you still be able to pay your bills? Would you have to give up certain plans or goals? Develop a concrete action plan for that exact scenario. Perhaps you'd realize you need a larger financial safety net, or maybe you'd conclude that you've taken on far too much risk. The paradox is that once you look your fear in the face and prepare for it, it loses its power over you. You stop fearing the unknown because the worst outcome has already been accounted for, and you have a plan in place. Think of this as a financial fire drill. It's always better to run the drills during calm times than to panic when the actual fire starts. Another crucial concept in Stoicism is amor fati, the love of one's fate. This doesn't mean you have to be thrilled about taking losses. It means accepting reality exactly as it is, without complaint or resistance. The market is neither your friend nor your enemy. It's not trying to make you rich or bankrupt you. The market is simply a force of nature, like the ocean or the weather. Sometimes it's calm, and sometimes it's stormy. Complaining about a market correction is as pointless as complaining that it started raining. You can't change the weather, but you can certainly grab an umbrella. In investing, your umbrella is your strategy, diversification, and composure. When you accept volatility as an inherent part of the game, it loses its power to frighten you. You understand that drops are just as natural as rallies. What's more, the greatest opportunities often emerge during the storm. Accepting reality is not an act of passivity. It's about freeing up the energy you were wasting on worry and denial and redirecting it toward intelligent, actionable steps you can take right now. Love your fate, even if it brings you temporary losses, because it is all part of the journey. Marcus Aurelius, the Roman emperor and one of history's greatest Stoics, meticulously kept a personal daily journal. He recorded his thoughts, his fears, and analysed his own reactions. So why shouldn't an investor do the same? Start keeping an investor journal. This can be a simple notebook or a digital file on your computer. Use it to record not only what you buy or sell, but fundamentally why you made that decision. What were your exact thoughts and emotions at that moment? For example, you might write, "The market dropped 5% today. I felt a surge of panic and wanted to sell everything, fearing further losses. But I stuck to my strategy and stood pat." Or perhaps, "I bought stock in company X because everyone is talking about it, and I'm afraid of missing out on the profits." After 6 months or a year, revisit those entries. You will be surprised to discover how often your emotional impulses led you astray. This journal will become your personal coach. It will expose your weaknesses, highlight your cognitive biases, and pinpoint your panic triggers. Keeping such a journal is a practice in mindfulness that transforms you from a reactive player, one who responds to every sneeze or twitch the market makes, into a thoughtful, reflective strategist. Seneca, another great Stoic philosopher, was actually one of the wealthiest men in Rome. Yet he constantly reminded both himself and others that true wealth isn't found in money. He famously wrote, "It is not the man who has too little, but the man who craves more that is poor." How does this apply to investing? Quite simply, in a falling market, we get fixated on the numbers. I'm down $10,000. My portfolio dropped by 15%. We equate our self-worth and our happiness with the balance in our brokerage account. Stoicism suggests shifting that focus. Ask yourself this fundamental question: why am I investing in the first place? The answer is unlikely to be just to have $1 million in the bank. Instead, it will probably be to provide for my family, to travel the world, or to ensure my freedom of choice. These are your true goals. A market downturn is simply a temporary fluctuation on the path toward achieving those goals. Your home, your family, your health, your skills, all of these things remain with you. When you remember your real values, a temporary drop in the value of virtual assets stops feeling like the end of the world. It's merely a ripple on the surface, not the shipwreck of your life. Remember that your portfolio is a tool for achieving a life, not the life itself. The modern investor lives right in the eye of an information storm. Dozens of websites, Telegram channels, and YouTube gurus are screaming advice. Sell now! Buy this stock, it's going to the moon. The crash is coming. This constant noise is the primary source of panic and thoughtless decisions. A Stoic approach calls for implementing a powerful mental filter. Before consuming any piece of news or advice, ask yourself 3 essential questions. First, is this information based on facts and truth, or is it merely someone's opinion and emotion? Second, is this information genuinely useful for my long-term decision-making? Third, is the subject of this news within my zone of control? You will quickly discover that 99% of financial content fails this test. An analyst's forecast about where the market will move tomorrow is an opinion, not a fact. News about a scandal at some random company is useless if you are a long-term investor with a diversified portfolio. Unsubscribe from everything that causes you anxiety or forces you to act impulsively. Keep just 1 or 2 reliable sources strictly for facts. This Stoic information detox is the single best thing you can do for your nerves and your net worth. The Stoics viewed patience as a cardinal virtue. For an investor, however, patience isn't just a virtue, it's a genuine superpower. The entire financial world is obsessed with speed, high-frequency trading, minute-by-minute news cycles, and instant transactions. We are trained to believe that constant activity is necessary to earn a return. Yet Stoicism teaches us the power of inaction. The great investor Warren Buffett, whose philosophy contains deep roots of Stoicism, famously said, "The stock market is a device for transferring money from the impatient to the patient. A falling market is the ultimate test of patience. Every fibre of your being screams, 'Do something.' But more often than not, the single most correct action is to do absolutely nothing. Simply stick to your plan, continue making regular contributions, and wait. The magic of compounding only works over the long haul. When you try to catch the bottom or predict market reversals, you stop being an investor and start becoming a gambler." A true Stoic understands that time is their greatest ally. They plant a tree and don't dig it up every day to check on the roots. They simply water it and wait patiently for the fruit. Your portfolio is that tree. The get-rich-quick myth is arguably the most destructive belief system in the stock market. Tales of people becoming overnight millionaires thanks to the latest hot stock capture our imagination. But for every success story, there are thousands of others who lost everything chasing those easy returns. The Stoics despise the pursuit of fleeting pleasures and immediate gratification. They value discipline, consistency, and focusing on the long game. This is precisely why Stoic philosophy aligns so perfectly with a long-term investment strategy. When you purchase not just a ticker symbol, but an actual share of a quality business, your bet isn't on tomorrow's stock price, but on that company's growth over many years. If a good company's stock drops 20 or 30%, it doesn't change the underlying fundamentals of the business itself. For the long-term Stoic investor, this isn't a tragedy. It's a sale. It's an opportunity to buy a quality asset at a discounted price. Greed pushes us to hunt for the rockets that might take off tomorrow. Stoic wisdom, however, directs us to stable companies that are built to compound value for decades. The choice is yours: fast, dangerous hunting, or slow, steady farming. Epictetus, another great Stoic who rose from slavery to become a respected philosopher, spoke extensively about freedom. But he didn't mean political freedom, he meant inner freedom. He taught that a person becomes a slave when they attach themselves to things they do not own and cannot control. Now consider this. How often do we become slaves to our own investment portfolios? We celebrate when they rise and we despair when they fall. Our mood and our self-esteem become directly tied to the green and red figures flickering across the screen. This, in Epictetus's understanding, is slavery. Your net worth is not your self-worth. You are not the balance of your brokerage account. To truly find freedom, you must create distance between yourself and your money. Repeat this mantra. My investments are merely a tool. They do not define who I am. When you break that emotional connection, you can make decisions about your assets much more rationally and objectively. You will no longer sell out of fear of getting poorer, or buy simply out of the desire to feel richer. Instead, you will simply be managing a tool designed to achieve your life goals. Investors often confuse two fundamental concepts: price and value. Price is simply what you pay for a stock right now. It constantly fluctuates, driven by crowd sentiment, breaking news and panic. Value, however, is the intrinsic, fundamental worth of the business backing that stock. It's far more stable based on the company's earnings, assets, and future prospects. A Stoic, much like any rational investor, always focuses on value, not price. In a declining market, the price of many excellent companies can drop significantly below their real, intrinsic value. The panicked crowd simply sells everything indiscriminately, without distinguishing between a good business and a poor one. For the Stoic investor, this isn't a cause for fear. It's a unique opportunity. They don't just see a falling chart. They see a chance to buy a stake in a wonderful business at a deep discount. They act like a smart shopper during a store-wide sale. If an item they've long wanted suddenly drops by half, they're thrilled and buy it, rather than running away in terror. To train yourself to see value, you must do your homework, study the companies, and truly understand their underlying business models. This is certainly harder than just watching the ticker price, but this disciplined approach is what allows you to maintain composure and even profit from market chaos. The Stoic virtue of humility teaches us to acknowledge the limits of what we know. No one can possibly know everything about everything. When we apply this principle to investing, we arrive at the crucial concept of the circle of competence. These are the industries and companies whose businesses you genuinely understand. Perhaps you work in IT and have a deep understanding of the software market. Or maybe you're a doctor and you know the pharmaceutical industry inside and out. Or you might simply be an avid gamer who can spot critical trends in the video game industry before anyone else. Your circle of competence is your fortress, your strongest defense. Focus your investments predominantly inside that circle. Why is this particularly critical when the market is dropping? Because when the stock of a company that you have meticulously studied takes a dive, you possess the internal conviction regarding its long-term prospects. You know the underlying business hasn't been damaged, and the price drop is merely temporary turbulence. You won't panic. But contrast that with buying shares in some random biotech company, understanding nothing about its research and development, simply because someone told you to. The first significant drop will fill you with dread. You won't know if this is a fundamental failure of the company or just general market hysteria. Invest in what you understand. This is a powerful Stoic principle that will save you a massive amount of stress and, crucially, a lot of money. Stoicism isn't about shunning risk entirely. It's about managing it intelligently. Seneca advised us to choose paths where the potential upside dramatically outweighs the potential downside. In contemporary finance, we call these asymmetric bets. Imagine a situation where you stand to lose $1, but could potentially gain 100. That is a highly asymmetric and favourable bet. How do you apply this logic in a bear market? When the market has already fallen significantly, the potential for further decline is often smaller than the potential for future gains. By buying shares in high-quality companies after a sharp correction, you are making an asymmetric bet. Yes, they might drop another 10 or 20%. That is your limited risk. But over the span of several years, they could easily surge by 100 or 200%. That is your significantly greater potential return. A panicking investor sees only the risk of further losses. A Stoic investor, armed with logic, sees the asymmetric opportunity. They don't try to catch the absolute bottom. That's impossible. They simply understand that the odds have already shifted in their favour, and they act coolly, spreading out their purchases over time to further mitigate risk. What is the Stoic perspective on diversification? At first glance, it seems like just a technical term, pulled straight from a finance textbook, but in reality, it's rooted in deep Stoic wisdom. Diversification is the practical acknowledgement that the future is unpredictable and outside of our control. We don't know which industry will truly take off in the next decade and which one will fade away. We don't know which specific company will run into unforeseen trouble. By spreading your investments across various assets, countries, and economic sectors, you are essentially telling the universe, I know that I know nothing. We can't predict the future, so we prepare for multiple outcomes. This is a powerful manifestation of intellectual humility. When one part of your portfolio takes a hit, another part may be growing, or at least falling less sharply, smoothing out the overall volatility. This protects you not only from financial losses, but also from emotional turmoil. A diversified portfolio is like a ship designed with multiple watertight compartments. Even if one section springs a leak, the ship stays afloat. It is your built-in mechanism for accepting the world's inherent unpredictability. One of the best ways to conquer your emotional weaknesses is to take yourself completely out of the decision-making loop. Sounds strange, but the Stoics would approve of this. They valued systems and habits that ensured you acted correctly on autopilot, rather than relying on willpower, which often fails under stress. In the world of investing, this is achieved through automation. Set up automatic regular contributions to your brokerage account, along with automated purchases of your chosen funds or stocks for a fixed amount. For example, on the 10th of every month, $500 is debited from your card and automatically used to purchase shares in an index fund. That's it. You don't have to decide whether or not to buy. You don't have to look at the market and stress about whether this is a good time. The system does everything for you. This approach, known as dollar cost averaging, or DCA, is particularly effective in a declining market. Your fixed contribution automatically buys more shares when prices are low, and fewer shares when prices are high. You systematically benefit from market downturns without even having to think about it. This is Stoicism in its purest form, creating a rational system that shields you from your own irrationality. Let's revisit the single greatest temptation during a market downturn, the urge to sell everything off. This is the fight or flight response, hardwired into us by evolution. Our brain sees the threat, the potential losses, and screams, "Get out now!" But the stock market is one area where following your instincts usually leads to disaster. Panic selling is the guaranteed way to lock in a loss. You turn a temporary paper loss into a very real and final one. A Stoic in this situation would once again turn to the dichotomy of control. Can I control the market decline? No. Can I control my finger hovering over the sell button? Yes. The decision not to sell is an active, disciplined choice, not passive waiting. It is your conscious commitment to sticking with your long-term plan. Think back to all the previous crises, 2008, the dot-com bubble in 2000, and every crash before that. After every single one, even the most terrifying downturns, the market eventually recovered and reached new highs. The only people who truly lost are those who sold at the bottom and never got back in. Patience and the ability to fight the instinct to panic sell. That is what separates successful investors from everyone else. Your job is simply to weather the storm. If selling into a downturn is wrong, perhaps buying is the right move. But there's a very fine line between stoic courage and sheer recklessness. Just buying everything that dips, that's a terrible strategy. However, acquiring high-quality, pre-selected assets at discounted prices, that's the epitome of investment mastery. How does a Stoic make such a decision? They rely not on emotion, but on logic and a predefined strategy. During calm times, they assemble a wish list, a roster of excellent companies they want to own but currently find too expensive. They define target entry prices for each name. When the market falls and prices hit those levels, they don't panic. They see this not as a crisis, but as an opportunity to execute their plan. Their action is methodical, not impulsive. This isn't a risky game of catching a falling knife. It is the cool-headed realization of a strategy. If you don't have such a plan, the safest bet is simply to continue your automated purchases of index funds. But if you are willing to do the homework, the falling market transforms from a threat into an ally, offering you the world's best companies at massive discounts. When the market tanks, the number of experts and self-proclaimed gurus multiplies exponentially. Your colleague, your neighbour, your best friend, everyone suddenly has priceless advice to offer. I sold everything, you should too. You need to buy gold. Quick, jump on this stock. I've got the inside scoop. How should we approach this from a Stoic perspective? First, remain calm and listen politely. Arguing is completely pointless. Second, pass every piece of advice through your own personal filter of reason. Ask yourself these critical questions. What is the actual basis for this recommendation? Does it align with my personal financial goals and my risk tolerance? Do I even understand the asset they are telling me to buy? 99% of the time, the answers will be a firm no. Stoicism is fundamentally a philosophy of self-reliance. You are fully responsible for your own decisions. Outsourcing that accountability to your neighbour or some anonymous internet guru is an infantile position. Use the information you receive as food for thought, but never as a direct guide for action. Your financial future belongs exclusively to you, and the decisions must be made solely by you, based on your own analysis and your own strategy. This is the definition of true intellectual independence. Ultimately, the goal of the Stoic investor isn't merely to survive the storm, but to emerge from it fundamentally stronger. The modern philosopher Nassim Taleb coined the perfect term for this concept: anti-fragility. A fragile object breaks when struck. A robust one resists the impact and stays the same. The truly anti-fragile object, however, improves when it encounters stress. How is this achieved? First, by constructing an anti-fragile portfolio. This goes far beyond simple diversification. It involves incorporating assets designed to benefit from market chaos. It means maintaining substantial cash reserves to capitalize on market downturns, and critically, avoiding excessive debt that leaves you exposed and vulnerable. But perhaps even more crucial is cultivating an anti-fragile mindset. Every single market correction you successfully navigate without succumbing to panic makes you a fundamentally wiser, more seasoned investor. You gain practical proof that your long-term strategy holds up. Your self-confidence soars, and your fear of future crises diminishes. You learn immediately from mistakes and swiftly adjust your plan. Market chaos ceases to be a threat and transforms into a training ground, a crucible that tempers your character and sharpens your investing skills. The ultimate goal is never to avoid volatility, but rather to master the art of harnessing it for your own profit and growth. All right, let's recap. What are the key takeaways from today? Investing isn't a high-speed sprint across a minefield. It's a long, patient marathon. And Stoic philosophy provides the perfect mental equipment for that entire distance. The main goal is to shift our focus away from things we cannot control, like those daily market fluctuations, and onto what is completely within our power: our emotions, our decisions, and our long-term strategy. A falling market is not a disaster. It's an inevitable phase of the journey. It's truly a stress test for both your investment plan and your character. And most importantly, market downturns are a time of enormous opportunity for those who remain cool-headed and act rationally rather than impulsively. Thank you for watching this video all the way through. I truly hope you found it valuable. If you found these Stoic ideas helpful or interesting, please hit the like button and subscribe to the channel so you don't miss future videos about rational investing. And of course, don't forget to tap that notification bell. Now, I have a question for you. What methods do you use to maintain calm when the markets are stormy? Do you apply any philosophical principles to your life or your investments? Let me know in the comments below. I'd love to read your stories and insights,